Is the Federal Reserve waterboarding the economy? I'm Michael Smith, and welcome to The Lowdown. Hey everybody, welcome to Lowdown. I'm Michael Smith. Joining me today is Kevin Lenox. Kevin, welcome to the show. So I mentioned waterboarding the economy, right? I know that's pretty harsh.
Wasn't expecting it.
Yeah. Most people know what that is. If not, maybe I can demonstrate. No? We'll pass. I got somebody else will do that too later. But anyways, well, what do I mean by that? Well, right now, I feel the Federal Reserve, we know they keep pushing interest rates higher. They keep raising interest rates, basically. And, one of the things you and I have talked about on a former podcast is that each time they have a rate increase, it takes about 6 to 9 months for that to really work its way through the economy. And, right now you kind of start to look at, we're in this camp of, do we have a soft landing, which right now I think probably the majority, basically think we're going to have a soft landing, but we're starting to see potentially could we move towards that, moderate to hard landing case. And one of the big reasons for that is we still have yet a lot of these rate increases have not passed its way through the economy. And if you're going to have economic growth, Kevin, you got to have one balance sheet really out there. It's got to be growing. And when you look at the consumer, and we'll talk a little bit more about that, the consumer, it's kind of flatlining. At least on the bottom, it's deteriorating, but it's really starting to flatline. On terms of corporate spending, that's pretty much starting to slow down, and we'll talk about margins here and earnings. And then, of course, we know the government. The Federal Reserve, the balance sheet is shrinking there, so there's really no expansion anywhere. So at some point, something's got to give. And I feel the Federal Reserve is going to just let's keep going until something breaks. But what are your thoughts right now on that whole soft landing and hard landing? Where do you sit on this right now?
I'm still in the moderate to hard landing camp.
Okay.
So the impact of rising rates has been delayed because households were very smart and they refinanced their mortgages when rates were very low.
Yeah.
I think 80% of all mortgages are below 4%.
Yeah.
So you're not seeing people move as frequently as they normally do. And that's kept home prices higher.
Yes.
Also, corporations, a lot of them refinanced their debt and extended the maturities. So the broader economy really hasn't seen the negative impact from rising rates, just because of the effects after the lockdowns from the pandemic.
Sure.
But it's still coming. And what we are seeing more and more evidence of is the lower quintile households with respect to income and net worth, and smaller, more leveraged companies are starting to feel more and more stress. But you don't see it if you're just looking at the S&P 500.
True.
So it's happening, and the longer the Fed stays on hold, they'll probably pause next month, not raise rates, despite the slightly higher CPI print today on the headline side. But they want to wait and see before they start to signal a decline in rates. Something has to hit first.
Yeah, well, walk us through. You mentioned consumer price index, so that came out. Walk us through. It did tick higher, and what contributed to it going higher, and then what is the Fed now looking at? Does that mean anything in regards to the Federal Reserve?
So it was largely within the range of expectations.
Okay.
So the call is still for the Fed to not raise rates next week. The headline was the somewhat of a surprise number at 0.6%.
Okay.
So that was 1/10 above expectations. Half of that was driven by the increase in energy.
Gotcha.
So a lot of this soft landing versus moderate to hard landing is going to come down to inflation, and I think with commodity prices leading the way, in which way that goes. I'm still an oil bull, as we talked about last time.
Sure.
It's a structural case for higher commodity prices, and just the way we've redone all trade globally, I think there's a higher plateau for inflation, and it's going to be very, very difficult to get down to 2%. Well, unless something really breaks hard.
Absolutely. Well, speaking of inflation, one analogy I'd probably use is that if anyone's ever surfed or attempted to surf before, there's a cardinal rule. Don't take the first wave of a set, and the reason being, if you're going to turn around and go back out, you got the next waves coming in that are going to hit you in the head. So you probably want to avoid the first wave. Well, I can think arguably we're through that first wave of inflation, and I think it's probably foolish to think that, well, this is one and done. I mean, the Fed is definitely in a quandary because they got it wrong with their transitory, right? It has been anything but transitory. But I think what they're not really setting up expectations for is that, there's likely more waves to come. Now, maybe the next waves aren't as strong as this first one, and to some degree. But I think inflation and the CPI print being a little bit higher than expectations, I think this is a common thing. We're going to probably see sometimes CPI spike and then it drops. But one thing I'm not seeing is these corporations, they're really not going to pass any decreases on to the consumer. I mean, if they've raised prices, they're likely staying there. And maybe over time they can't keep raising them and it'll average out. But for now, we're kind of stuck with this higher price scenario. What are your thoughts on the inflation front?
Yeah, so we've talked before about how margins have stayed resilient, particularly for the top companies, and we'll get into it more later on. But these quality companies, a lot of them are basically oligopolies.
Yeah,
and they have dominant market share. They have pricing power, and companies like FedEx and Pepsi have said that despite higher input costs, they've raised prices on top of that because they can.
And the consumers happily continuing to buy. So, I mean, volumes have actually decreased, and they're still, they raised the price, and I mean, they're still making the same profitability, if not more.
We look at the, cost of borrowing between large companies and small companies.
Okay.
It's somewhere around just over 3% for the top 100 companies in the S&P 500. It's twice that, so 6%.
Now double.
For the smaller companies. When you look at operating margins, those top companies are about 15.5%. Russell 2000 small cap, just over 5%. And the cherry on top with that then is net borrowing, net interest payments have actually decreased for a lot of companies, particularly the mega cap companies.
Yeah.
So they locked in low rate debt, and now their cash on the balance sheet is earning 5%. So again, not having the negative impact of rising rates that the Fed has been looking for.
Well, like you said, I mean, that's a small handful. The Magnificent Seven is, often what we refer it to. That's been a big driver. I mean, I do think, and we did see some bigger participation in this rally. That's kind of caught a lot of people from surprise. I mean, we talked on a previous podcast that the fear of missing out, FOMO. A lot of people, this rally took them by storm. But here we are in September. September is, considered one of the more volatile months. But we're about to move into that seasonally strong period, October through December. And I'm just wondering, I think most everything's priced in right now. So nothing, at least on the horizon, to shock the market or at least create the uncertainty. But I mean, do you think that money managers, you think people start putting more money to work kind of in this last leg of the year? Do you think that happens, or do you think something could change that narrative?
I think from a positioning and flows standpoint, the market is sort of normalized.
Yeah.
Here, I don't really see its extreme positioning, particularly in the equity market here.
Okay.
But there are definitely preferences that within the market that are changing. The quality that I mentioned, but a shift from we look at small cap companies again.
Okay.
Negative 1% over the past year, whereas the S&P 500 is up 10.5%.
That's a big divergence.
So
yeah.
So there's been more of a gravitation that way, which is correct.
Yeah.
Based on where we are in the business cycle, late stage, maybe on the edge of a recession. What we were looking for, and it did happen finally in mid-May, was outperformance of cyclical stocks.
Okay.
Versus defensive companies, which started in May.
Mm-hmm.
It's gotten a little wobbly here over the last few weeks
Sure.
when oil has really spiked up, but that was one of those necessary ingredients, we think, for the soft landing scenario. So we'll see if that reasserts itself. But overall, focusing on high quality, I think, is really the most important thing to do at this point, and for the right reasons.
Well, I think you brought something up, and it reminds me of a conversation. I had someone in general ask me what they thought of an IPO, initial public offering. And, I didn't even really get into asking what it was. My comment back was, typically in the late cycle, which you just mentioned where we are, this is where a recession happens. And I said, it's probably not the right time to buy that. I mean, considering we're in a late cycle, potentially going into a recession or in a recession, and typically those haven't done well, by the way, the ones that have come out, and typically not a great time. So knowing where you are in the cycle, I think is very important. And if, you kind of hit on it, but maybe kind of reemphasize in the late stage, where do you feel like, as far as the equity side of the equation, where do you think people should be really focusing in regards to writing this out on the equity side of the equation?
Yeah, I think still the large cap, and really focus on those quality companies, which I just keep saying.
Yeah.
But it makes sense in that these are the companies that are, again, basically oligopolies. They have the lowest borrowing costs. They have the highest margins. I will throw in there that they also have the most effective lobbying efforts. A friend of mine is a CFO, used to be a CFO for a company, and he commented that it was a very high return part of the business. They invest millions in lobbying efforts to make billions. And in big pieces of legislation, a lot of times, people in Washington really don't know what's in the bill.
Sure.
It's the lobbyists.
Most of the time.
The lobbyists that write it.
Yeah.
Heavily influenced, if not directly participating, are those large companies.
Well, you and I off air talked about this, and I thought maybe for our listeners, kind of give an example of a company that can continue to pass on price increases, or at least hold the line. You talked about airlines, and you had a great example I thought maybe you could share with us.
Yeah, so we've talked about the K-shaped economy. The
Yeah.
top 10% are doing very well.
Mm-hmm.
The bottom quintiles, are in income and net worth are really struggling here. So if you extrapolate then to the airline industry,
Okay.
Delta and United, which have a lot more international flight, that they are doing significantly better than the likes of JetBlue, Southwest Airlines, and Spirit just made the news today. They downgraded their earnings forecast. They're facing higher fuel costs, as everyone is. But also they're having to discount fares just to get people to travel, because the typical Spirit type of flyer is constrained from flying as much as they used to. So those types of decisions, you look at the luxury stocks, the
Yeah.
high-end luxury stock, and then you look at Macy's and discount type companies. So aside from just the quality theme, look within each sector and say which type of companies are more insulated than others.
Well, and that's a good point. I mean, so what basically that example is telling me is that the top end of the consumer is still doing well and holding the line, even though we're seeing credit card expansion there. But the lower end of the consumer is definitely deteriorating. And and as we see these rate increases kind of continue to pass through, we may see more deterioration there. And by the way, Spirit Airlines, if anything, they break your spirit. Not my favorite. So no wonder in that example what's happening there. Well, Kevin, all the great information. I think again, like back to your point, staying in the quality stocks. We're at the end of the cycle. Knowing where you are in the cycle matters. It's very important. We are getting in that seasonally strong period. Like you said, everything seems to be priced in. But that's why we come here every month. That's why we'll talk about this. And if things change, we're going to be the first to inform you. But I want to say thank you for joining today, and we'll see you next month.
Sounds good.
All right. Thank you for joining the Lowdown.